In this morning's U.S. Bank Economic 360, closing the book on the first quarter. It's time to take a look back at a rough start to the year for the stock market. U.S. Bank Senior Vice President Mike Denneman joins Business Courier publisher Jamie Smith in the studio to talk about what happened to stocks during the quarter and what that means going forward. Jamie and Mike.
Thanks, Peg. Mike, thanks again for being here.
Good morning.
All right, as Peg said, a rough start, crazy start. Talk a little bit about it.
Sure. Yeah, no doubt it was a wild ride to start the year. And it seems like a distant memory now, but recall that January was actually one of the best starts to a year that the market had ever seen. Right. And so we started off with a bang, and unfortunately from there, it went downhill. February, not a good month. Kind of reintroduced us to the word correction. We hadn't used that in a while, and so that wiped out all of January's gains and then actually into negative territory. And so hoping for March to bail us out, but that did not happen. The month ended negative, which ensured that the quarter itself was negative. So yeah, not a good start to the year for the market.
So what does that roller coaster ride tell us?
Well, I think a couple of things. First off, it tells us that the volatility is back in a big way. So looking back to last year, 2017, not only a record year in terms of market highs, but also in terms of low volatility. You know, the trend line was very smooth, not any corrections, no pullbacks, and that's just not how the market usually operates. So the market's messy. We just haven't seen that in a while. So we're kind of reverting back to that typical pattern. But then it also tells us that we've now broken what was a pretty nice streak of consecutive quarters of an up market. So we started the year with 9 straight quarters of market gains. Clearly we've broken that now, but it was a good ride. We have to look back to the fall of 2015 to find the last time we had a negative quarter for the market.
Yeah, we had a lot of talks throughout the last year and a half about no need for correction. Well, what does that mean for the rest of the year? I mean, what do we need to look forward to? Or
Right. So I think what we're seeing now is that there are a lot of investors who they look out and they see a glass that's half empty. They're worried about inflation or rising interest rates or a potential trade war. But then on the other hand, you see a lot of investors who see a glass that's half full. The economy's doing well, unemployment is low, the tax cuts are kicking in, and so you can make an argument on either side. So what we're seeing, I think, is a tug of war between those two sides. One thing that we'll have to pay very close attention to will be, here just in a few short weeks, the reports about corporate profits for the first quarter. Corporate profits have been rising over the last couple years. That's been a key to the market having done so well. So all eyes will be on, okay, we had a bad quarter for the market. Does that translate to a bad quarter for corporate profits? And if so, that could be another negative for the market. On the other hand, if it's a good quarter, that could help the market to rebound.
Yes, a little bit.
Exactly. So that'll be here in a few weeks, so we'll keep a close eye on that.
All right, we'll look at the results of Q2 before you know it. All right, thanks so much, Mike.